On this episode of the Today Counts show, Jim talks with financial advisor and author Tim Rosen. Tim is the founder and principal of Financial Compass, a registered investment advisory firm based in Central Tennessee. In this financial masterclass, Tim is going to give you the secrets and keys to growing your wealth and doing it the right way. Welcome back to the Today Counts show with Jim Piper. Before we jump into today's episode, we'd like to recognize all those who make this podcast possible. The Today Counts show is supported by the generous donors of the Lead Today community. Also, be sure to subscribe and follow the Today Counts show on whatever platform you watch or listen. All right, let's get back to the podcast.
Hey everybody, welcome back to the Today Counts show. As you may or may not recall, you are joining Tim Rosen of Financial Compass and myself, Jim Piper, right in the middle of a discussion about money, about teaching kids about money, investing, financial planning. I'm going to throw some questions at Tim here and there. Maybe I'll throw some stuff about crypto at him or Social Security. But where we're at in the conversation is, how should we approach investing? How should we approach financial planning? Let's start, Tim, with just saying that we're younger, and then maybe progress from there. So from those that are like in their late teens, early 20s, why don't you pick it up from there?
So as you are aware, and your listeners will be aware, there's no shortage of approaches, philosophies towards, how to invest. There's about as many approaches as there are opinions. We hold to a philosophy that believes that, look, growth comes from the markets themselves, not by trying to time or play the market. And that's supported by scripture as well. He who is hasty to be rich will not be innocent. So the success in the market does require discipline and take some time. When you are young, and however young that is, I have someone who's just turning 18, can't wait to start his Roth, and I'm very excited for him that he sees the benefit of that. It's hard for a young person to look ahead and to even think about being in their 60s. But as you and I can attest, the years click by. So it's important to start young. And what's important for a young person is to maximize their growth. They have time on their hands. They have decades. And so when we believe and we see, the evidence shows us that markets just keep growing. Yes, they've got all their little dips and such in the short term, but it grows. Then the younger you are, the more you should be more into, and you should hold equities, stocks. We need diversification. We don't want one or two hot stocks. We don't want to chase hot sectors. If you own U.S. stocks, you own international, you own large, you own small, and you stay disciplined. You keep feeding that. What benefit of these young people, just as it is a benefit for those in their 30s, 40s, and 50s, to make regular contributions, regular investments every pay period. You want the market to go down because then you're going to be buying quality investments at lower prices. So this combination of consistently investing in your future self by making contributions, pay period after pay period, month after month, year after year, decade after decade, is going to pay off for them. So in other words, we would look at the younger you are, you should be about 100% equities. We don't need bonds. Bonds are for stability. We don't want to say security because there's really no security in investing, but bonds do kind of level out the volatility.
Hey Tim, let's define what a stock is, what an equity is versus a bond, just so that folks are understanding what they're actually investing.
Oh, absolutely. And that really ties into supporting the conversation around what is capitalism as well. Mm-hmm. We've got a new generation that is just, pushing. They think that they want Marxism and socialism. They couldn't be more wrong.
Yeah, right.
When you have a stock, that is one share out of so many millions that the company has sold to the public, and you own one share of that company, and you want to participate and benefit from that company's growth over time. So the more shares you have, the more you hold of that company or many companies. And so publicly traded companies went through an initial public offering. They sold the company to stockholders. Now their profits, now their commitments, now everything they do is all focused on building stakeholder shareholder value.
Right. So as a young person, when I'm investing in stocks, my posture, which word do you like better? Is my posture an investor in businesses? Is it an investor in the U.S. economy? Is it an investor in the markets?
Yep.
Um, what do
Yeah.
you like? What any of those words better than
Your
the other?
your position would be you are trading your capital. You're investing so that publicly traded companies can have your capital for research, development, and expansion. So you are investing in companies. Look around your house, look at the books behind me, look at the car you drive. These are companies that needed capital to create and bring a product or service to market, and that's an ongoing process. So as you look around, it's exciting to know that you could be a part of, think of innovation. You're an innovator, or else we wouldn't be doing what we're doing right now. Entrepreneurship. It took risk, it took vision and innovation for someone to bring a product or a service to market. If their product or service is successful and it brings what the consumer desires, then they have a right to earn a profit. As partial owners of these publicly traded companies, we benefit in their growth. So then the magic comes when we diversify. Not so much mutual funds; those are really heading out the door. They're really old school, clunky, costly, and custodians, companies that actually hold your money, are starting to charge more to uh, process mutual fund transactions. So now we have ETFs, exchange traded funds, like the cousin, the forerunner of the mutual fund. You still have one investment that holds perhaps 100, 200, 300 companies, and it's going to have a different flavor. Maybe it's technology, maybe it's US large, maybe it's international small. You buy shares of that. If you had one share of that ETF, that one share allows you to own hundreds of companies. So it's very cost effective. You can diversify by owning these ETFs. And that's not an answer in and of itself. Hey, Johnny, go buy ETFs. You still need a plan. Still need some wisdom and discernment as to what categories you're going to own. But it's certainly a tool that does all the heavy lifting for you, saves you the cost of trying to go out and buy 300 companies yourself.
Yeah, your point's well taken. I remember a conversation I had with my boss when I was a young man at Bank of America, and he would always encourage me to give monthly, to take that IRA contribution up to the maximum, and as well as the stock purchase plan that we had at the bank,
Oh yeah.
for B of A, and so there's all kinds of different types of stocks, types of companies. So when we say type of stocks, we're really talking about type of companies, verticals, if you will. And, again, just helping the young people, they're in a broad sense. Yeah, we used to call them blue chip stocks. I don't know if they're still
Yes.
called that, where
Uh-huh.
you're not, you're investing in growth, but it's a safer bet where you're looking more for a return on dividends. Whereas a growth stock, typically a smaller company, like you were saying, innovation, um, maybe a little bit more risk, but a little bit more upside also to the value of the stock. But how do these then differ from bonds? I just want them to know the difference between stocks and bonds.
Sure. Historically, since the beginning of the stock market, the stocks, equities, have always paid a premium, so a higher rate of return over a bond. A bond, nowadays, you're not buying a bond at a $5,000 face value. You're buying a bond fund. But what happens with a bond is either an entity, a company, or a government needs to raise money. So it's a debt to them that they're going to sell these bonds in exchange for giving you a set interest rate for the duration of that bond. Your principal is returned to you upon the maturity of that bond. There are short-term bonds, 18 months, 5 years. There are long-term bonds, 30 years. Don't recommend long-term bonds. A lot can happen in 30 years. But basically, you give your money to that entity in exchange for regular interest and the return of your principal at maturity. So, I mean,
Yeah, and so
there's a safety feature there.
sure. But if you trade a bond, why is it that sometimes you are trading below value, trading above value?
All right, we're going to get in the weeds. Let's talk about how the Feds messed up banks and our bond industry. Let's go back to that 30-year bond. Let's actually go back to 2008. The government panicked, and in order to kind of get the economy going and helping banks to start lending again, because they got spanked pretty bad, they dropped interest to zero. Who wants to buy bonds? Well, they still had to issue bonds. Banks need to keep your deposits. They need to have reserves. They're going to try to make some money. And they have to. So they're going to layer and they're going to buy a bunch of long-term bonds. Technically, the longer the duration, the higher interest you can get because you're giving that money to that entity to work harder and longer with your money. At the time, about 18 months ago, 14 months ago, perhaps, when the government substantially and frequently increased the interest rates, not by 0.25%, but by 0.75%, banks couldn't keep up. They had their reserves tied up in 30-year treasury bonds paying 1.1, 1.4. Seemingly overnight, in just a matter of months, now new bonds are paying 5%. So, Jim, you're a customer. You're ready to buy a bond at $5,000. Do you want to buy the bond from the guy who has the bond that's only paying 1.2 for another 20 years? Or do you want to buy the bond with the same money? $5,000 will get you a bond that pays you 5%. Well, of course, we want the higher interest. So we had a liquidity problem. Banks couldn't get rid of their bonds. Bonds are traded at face value. Who wants to pay face value and get 1.4 instead of 5? So what happens is they have to sell that bond if they want to get out of it at a steep discount,
right,
a loss, to where their purchase price, maybe instead of 5,000, they sell for only 2,000. So the interest on that 2,000 equals the interest at 5% at 5,000. So losses.
The purchaser is gaining interest, so to speak, on the differential between the face value and what they actually paid for the bond. So it's an opportunity to purchase depending upon how much the bond is discounted. Right.
Well, in the secondary market, if you had long-term bonds, you lost money, or you at least saw your bond fund drop in price. So you don't want to get stuck with the bond paying a low interest rates when bond interest rates go up. Yeah. So it's called interest rate risk. So now bond values are high. It's good to have some of those because any day, any week, the Fed's been talking about it a long time. Hey, they're supposed to be bringing rates back down because inflation is back in control, they say, or they're waiting for that to happen. So there can be risk playing with bonds. Inside of an investment portfolio, however, it's more efficient to have a bond fund, just like an exchange traded fund that holds hundreds of companies. A bond fund will have thousands of bonds that are overlapping in their maturity. They've got a bond maturing today. They've got a bond maturing next week, next month. So there's more liquidity, but you still benefit from the stability that what is called a cash equivalent brings to a portfolio. The younger you are, the less you need that. You want the volatility. That's how gains are made. Growth. Without volatility in a vacuum, don't expect any growth. So getting back to our younger investors, start early, start regularly, buy and invest on a regular basis. Don't stop, because the value of time cannot be over
emphasized. Yeah.
Emphasized. Thank you. That's the word I was thinking of.
Well, and you drove by a term that, my purpose for asking these questions that are kind of down a rabbit hole is I don't want to scare any young person that maybe doesn't have any business, formal education, because you kind of drive by these things when you're an undergrad in a business program. But however, I think it's important to realize that there is some level of complication or intelligence and understanding, experience, etc., that younger investors can benefit from. They may not have to get a full-fledged financial counselor, but they need to have some sort of guidance.
Yes.
I think, which is really important.
Hmm.
And for example, you mentioned the bank's reserves. Well, many may not even know that the FDIC requires what I just call another form of hedging, because the bank never has the cash on hand. If
Correct.
they were to get a run, meaning all the account holders want their money, they don't have it. So instead, the hedges, they've got to keep X percentage. So when you have a checking account, that's actually a liability on the bank's balance sheet. When they have a loan, well, that's an asset. However, it's a fixed asset depending upon how long the loan is, and not as liquid. But to your point, then you have bonds. Bonds are very similar. They kind of play in that world. So it's just important that when I'm a young investor, that I just don't listen to the sound bites here and there, get caught
Absolutely.
into different marketing schemes,
Right.
and find somebody in your life, find some education. I mean, your website gives that opportunity right there, to reach you and to learn in that way. So let's say you get a little older now. Oh, wait, let's back up. Is there a certain vehicle? You've mentioned funds and stocks and bonds, et cetera. But when you talk to these young people, these younger adults that are now beginning to bite the bullet, and they're saying, gosh, everyone's telling me that I need to start putting money aside for the future, and I'm going to do it. Do you encourage them to do this through an IRA, through a Roth? What vehicle do you usually encourage people to use?
Great question. With recent changes by Congress and their regulations and requirements, employers of certain sizes, I think all employers in California, are required to make available to every employee a retirement plan. An employer-sponsored retirement plan allows them the means by which they can invest through every paycheck. So the most common is called the 401k. Not to get
401k.
not to
Yeah.
get tripped up with those numbers and letters. It just references the Internal Revenue Code section that speaks towards an employer-sponsored plan. Now, nowadays, as an incentive, as an employee benefit, as a means of attracting and keeping good talent, especially your larger companies are going to match your contribution. We won't get into the history as to why we came up with 401k instead of pensions, because it's a done deal already. Most people aren't earning pensions unless you work for the government or school system,
Well, the
the
long and
county.
short of it is some of those pensions disappeared.
Yeah.
That's one of the answers, right? But there's probably
Yeah.
multiple reasons. Yeah.
Oh, and liability switches from the employer to be, instead of them holding on to enough money to pay you a pension the rest of your life, the focus and the liability turns to you, the employee. You put your money in. Now, you have to be careful, listeners, because the 401k company cannot serve as a fiduciary. They cannot be responsible for investment advice. Do not look to them. They cannot tell you. They can't answer your questions. Well, how should I split this up? Should I be what percentage in US and international? They can't. They're going to give you glossy brochures and give you examples based on your age and how to slice
And
that
and
pie.
and yeah, and there's mostly like a menu that you get to typically choose
Yes.
from to make it
Yes.
more user friendly. But
Yes.
in the user friendliness, you are also limited in some degree, usually in your investment opportunities.
Absolutely. Your company is going to partner with a financial company, and they're going to choose what funds are going to be available in your plan. My first book I wrote, Against the Grain, shouts out some warnings about 401ks and gives you some warning about following conventional wisdom just because everyone is doing it. What you find many times, if you're in a 401k for a number of years, your company or the finance company will start to change the funds that are available because a new fund company comes in and it's called revenue sharing. Hey, we're Dreyfus. And if you make us part of your 401k plan, we'll give you some revenue sharing. And so your employer has a financial incentive to only have certain funds. I've had many clients who are still working. They have their 401k and they say, Tim, what's this notice? Oh, the XYZ fund is going to be no more come October 1st. It's going to be replaced by the ABC fund. Like, why? Why is that? There's some financial interest going on, and it's not your financial best interest. The last thing you want to do is set up something that's, by design, and you're staying committed and you're staying disciplined, and they're going to upset that apple cart by getting you out of funds that were, what if they're down and you've had them so long, and now they're going to bring in another fund and you have to put your money in that, and maybe that fund is up and you could realize some losses there. Kind of getting into the weeds, however, on 401ks. If you've got some decent choices in your 401k, in my book, I make it very easy to understand. Yes, there can be some benefits to the 401k. Primarily, automation makes it easy right out of your paycheck. You don't even have to think about it. There's other ways to do that outside the 401k. But the only time that I say yes, invest in your 401k is if the company's giving you a match, and that's free money.
It's free money, right? It's free money.
It could be dollar on the dollar, 50 cents of their dollars for every $1, or 25 cents.
At least
that's subject to change.
Yeah, at least take it to that number, right?
Yes.
I mean, take advantage of that free money, so to speak. And that's exactly what I called it at B of A. That's free money.
It is.
And you run with it. And another thing of encouragement that I would like to share is, and you started off this podcast, reminding people that it really is foolish. It's not in God's engineering to seek get rich quick schemes.
Yes.
And it's not. I'm not pushing back on that at all. I believe in that 100%. However, what I will say is that when you become an investor, if you have that mindset, you'll be surprised sometimes the windfalls that will come in your life by being a faithful investor. The story that I have is I bought an over-the-counter stock when I was a young man, and I had planned on keeping it, for as long, but it grew so fast over a period of like 7 years that I was able to sell that stock and use that money as a down payment for my first house. You just never know. But the long-term play, the point is that I was investing, as you said, early and often.
Mm-hmm.
And often.
Yes.
And I would probably say I could have done a lot better in that realm.
I think hindsight's 2020. We can all say that.
Yeah. You're just surprised what time does. And playing catch up, even though there are catch up laws it just doesn't work, and at least not to the extent of being faithful in your investing over time.
Right. Which brings us to the matter of warnings. When you start to see, to what you were saying, Jim, you're starting to build up and wow, look at this, I'm really accumulating. And you're a young person that's not used to seeing a balance of 20 grand. And you think, holy cow, I got 20,000 there. I got $100 in the bank, but I got 20,000 there. And I really want the new flat screen TV, or I can really use some new wheels. That is not your savings account. That is
Right.
not go-to money. You're going to get struck with taxes and penalties.
Capital gains.
So that's going to be a huge cost to you. Taxes, penalties for not being 59.5, and then the cost of what's called opportunity loss. You took 20,000 out. How long did it take you to get there? You can't make up for lost time. You'd probably have to triple what you were contributing just to try to catch up. But then you're also missing out on what that 20 grand also can earn in the years that it takes you to make up 20,000 again. You don't want to touch that money.
That's so good. So when as you start investing, have a mindset of the long term, and that's That's how you
Yeah.
want to go. All right. So we're getting a little older now, and the main thing that you said here with the younger folks is get started. Maybe get some guidance. Be faithful. Don't view it as a savings account. It's a long-term investment. Trust the long haul.
Hmm.
All right. So what age group should we jump to next that might create or change of life situation that you might add some coaching to that's a little different, or maybe not different, but maybe an add?
Great choice of words. So there's guidance along the way, along the journey. You're going to have temptations to maybe switch up your game, switch horses, so to speak. The, the evidence shows that the more you can stay put, if you have structured your portfolio to be, I could use the term truly diversified, but I'd have to work one-on-one to see if you're truly diversified. You're owning different categories of the market. Besides large, there's small. Besides US, there's international. There's emerging markets. There's distressed companies. We call them value. They give us more growth than a growth company. So if you're setting that up and you're constantly feeding that, you're really keeping yourself in balance because every purchase is buying more of what you've already set out to do. So then between 18 and say 30 in your mid 30s, the challenge and what you need to do is stay focused and kind of have, how the horses have these little blinders, because you're going to see all of these temptations. Oh, Bitcoin. Oh, Nvidia. Man, if I could just find that first Nvidia, the next Nvidia, then you start comparing water cooler talk. Your coworker says, "Oh, I just did this, on this app." Hey, it's always been easy to access and get an investment account and to trade stocks. That the process is easy. Click a button. E-Trade had a very infamous commercial with the little baby and some older guy's voice saying, "Boom, Shankopotamus. I just, I
Yeah,
just bought a stock.
you have to
Boom."
admit though, those are great
They
commercials.
were great. Show you how easy it is.
Yeah.
However, the reality is to actually make money and not lose money. That's
Yes.
not easy.
Right.
To click a button to send $500 into an account at Schwab, easy. Your 500's ready to invest, to get a stock symbol, buy it, easy. But it's not easy to do it right. What you're going to own. So here's the truth. A 96% determinant as to what your money is going to do is asset allocation. What you bought, what investments you have, and to what percentage. So I'm going to back up and say that again. The determinant of what determines your growth, 96%, is the investments you have and to what proportion you have. So you have to be wise with that, and then stay disciplined for the long term to keep holding those and buying more and not get sidetracked with hot sectors. There's always bubbles. There's always hot sectors. Thankfully, hey, look, the Apostle Paul warned us to compare ourselves with yourselves is foolish. So don't get a little bit of nugget from this guy who got all excited because one time he made some good money doing this, but to do it repeatedly, consistently, persistently, no, it's not going to happen.
Talk to that's good. And the way I'm reading into that is, all right, so you got a little bit of swagger going on now, and you've got some money, and so you want more, and now you've lost some patience, and you're looking to, oh, I can do this myself, or like you said, water cooler talk or whatever. So you can get distracted. You had a good thing going, and now you get distracted. I mean, distraction's a good word. I can think of another D word though, and that would be discouraged or disillusioned when the market bails on us, right? When it falls apart, then it freaks us out. What year was that where our most of our portfolios lost? What was it? 30%, 40%, something like that?
2008, the banking crisis, the
Yeah.
market crash, S&P went down about 52%.
Right. So when that happens, so you got the person gets distracted, they become the do-it-yourselfer, and then you've got the guy that's loving getting his statements every quarter or month or how often he or she gets it, and then all of a sudden the markets fall apart, and then they get discouraged or disillusioned, maybe fearful, and then they do the horrible thing, they pull out.
So there's a whole discipline of study, academics in that category. It's called behavioral economics. And I'm a huge student and have been for 15 years or so. So I understand, and the value I bring to our clients, and you just can't teach it all on a podcast, is to speak to and to help them in that behavior, because it's not the markets that destroy wealth. It's your emotional decisions and the actions of the investor themselves.
That's good.
So DALBAR, it's an acronym, DALBAR, along with Morgan Stanley. They've done research going back 20, 30 years, studying the markets and studying individual portfolios. And they have seen that it's the investor that hurts themselves. Markets come back and they go on to new heights. You mentioned that huge crash. We did okay. We did very good. As a matter of fact, just the S&P, now actually the S&P, bad example. If you're properly diversified, you about tripled your money over the next 8 years after that crash. So March 2009 was the bottom. 100,000 went down to about 60. But if you held it for the next 8 years, you had about $300,000 in a diversified portfolio.
So I think we've been talking about that late teenager, early 20s to maybe now mid 20s, mid 30s. Maybe we're talking now about the more mature, we're halfway through our life, so to speak. We're in our 40s, maybe touching 50. What do you say there?
This is what I'm advising. Look, life is full of trade-offs. You probably have children now or teenagers. You've got extra costs in life. You need to, I say need because I want to speak to what they need to hear, not what they want to hear. Trade-offs are, now it's time to start dialing up how much you're setting aside for yourself. When you were just starting at 18, you weren't at your maximum income potential. So $100, $200 was a stretch for you. Now $100, $200 isn't so much. Start dialing that up. The reason is we all will need more than we think in the future. And you just can't set that date in stone. I know Social Security does, and they keep pushing that carrot out further and farther. But what your future is, A, you physically can't work anymore. B, age or disability or sickness. Or C, legitimate retirement. You're going to need income. Where's that income going to come from? Well, we've been working on that for decades. It's important to know what you're looking for. So if you have $500,000, you say, good night, I've never had 500,000. I'm rich. Yeah, if you took it all out at once. But what does that translate to income-wise? It translates to about $20,000 a year. I can't live on $20,000 a year. Yeah, especially if it's taxable in a 401k. Now you're taking home $15,000. Try to live on $15,000. Well, Tim, you're depressing me. No, I'm encouraging you that it takes more. It's the trade-off in life. So we don't have to be taught how to spend money. It's easy. And there's so many, we're bombarded with temptations all the time. We live, and you've seen this, Jim, in a subscription culture. Just click here, just for $9.99 a month, for apps, for games, for movies, for book subscriptions, for cologne subscriptions, barbecue of the month. Everything is like, okay, I'll do that. I call it financial death by about 1,000 cuts. You just keep saying, oh yeah. I want Hulu, I want Netflix, I want Paramount, blah. And it just keeps adding up. You are making, whether you realize it or not, an adult decision to, the Bible calls it strike hands. Don't be one of those who strike hands or quick to strike hands. You're saying, yes, you're making a financial obligation. When you do that, you're making a knowable trade-off. You don't have those dollars to work for you anymore. We need dollars, especially now you're a homeowner. A homeowner needs more money in the bank. Things happen, and it's your responsibility. Appliances break and need to be replaced. Trees fall and need to be removed. Windows need to be removed. HVAC systems need to be replaced. That costs money. The tires need to be replaced. Things happen in life. So now as you have more responsibility in life, it takes more focus to pay yourself regularly in the bank savings and invest regularly. And you need to dial that up. That's why a percentage is a good discipline. If you started out, let's say, actually, if you started out at 10% and you never changed it, but you went from earning 20,000 to 30,000 to 60,000 to 100,000, and that percentage stays the same, you're still investing more dollars. 10% of 100,000 is 10 grand. But back when you started your first job making $25 an hour, nowadays, you're 10% of 20,000 is 2,000 a year. So the percentage stays the same, but you're actually contributing more money as you get older. You can stick to that discipline. It's going to benefit you very well.
Great. Now let's graduate to that, right around that so-called retirement target. Maybe I'm 55, maybe I'm 65, maybe I'm 70. What is your conversation there?
We have to have conversations before we get there, and I haven't touched on that yet.
Okay.
And that is,
well, let's go back and touch on that. Yeah.
Well, to get there, we have to decide now: do we want tax-free retirement money or 100% taxable? Because the carrot that's waved in front of you now is to get a tax break for contributing to your 401k or IRA. You put $6,000 into a traditional IRA or your 401k, and you made $60,000 for the year, then you deduct that $6,000 from your $60,000. Now you're only going to claim $54,000 in income, and that sounds appealing. But what that is in reality is a temporary tax deferral. You're putting it off till guess what? Till when you need it, when you retire. I've done the math. I gave an example in my first book, Against the Grain, someone who's putting $500 a month into the 401k and how much they save every year. And it sounds good, but now we go to retirement. And now your income needs to come from that retirement account and you start drawing. But guess what? You put in $6,000 a year, that's $500 a month. You're not going to live off of $6,000 a year. You're going to need to take a lot more. So let's say you take $60,000 out a year and you're in the, let's call it low, 15% federal tax bracket. You're paying $9,000 in year one in income taxes. You didn't save $9,000 year one putting money in. You saved maybe $900. You will give the government far more in taxes in your retirement income if you go the traditional tax deferred route versus tax free, which is your Roth. To that, many companies now in their 401k, you have to ask them, do you have the 401k Roth? Most of them do now. So if you go for that option, your income that you earned on your paycheck, they're going to calculate all the taxes, and then they're going to make your contribution after taxes. So your seed money goes in after tax. But all these years of compound growth and decades, now you've got this huge amount. You can draw from that and have your $60,000, in example, completely tax-free, federal and state.
Well, let's go back even further. Are you suggesting the Roth from the get-go and
yes.
all the way through? Okay.
Right, because you can't decide at retirement, okay, I want Roth. Nope, you needed decades. You needed time to contribute your seed money that would grow. So people are talking about Roth conversions. There's a problem with that waiting till later. You're still going to pay, I'm going to say it, the piper. You're going to pay the piper. You're going to pay the IRS.
You can pay the piper. I'm good with that.
Pay Jim Piper. You're going to realize that as a taxable withdrawal, then it's going to convert into a Roth, and that's going to need time to grow to make up for all the taxes that you paid. And then you reset the IRS requirement that you have to wait 5 years before you can touch that without penalty. So you don't want to wait till you're getting close to retirement to do a Roth conversion. You want to feed that Roth month in, month out, year in, year out for decades. It only came on the scene in, I believe it was 2001, named after Senator Roth, who proposed it.
Great. All right. So now we're talking about the 60-ish individual? What does your conversation look like there?
So we're going to start dialing down the volatility. We're no longer trying to knock it out of the park, grab the brass ring. I keep making that light appear. Um, we're no longer going for growth. Now it becomes, I want to start preserving this. I want to hold on to it, but I still need modest growth. And I'm going to have a conversation. Remember, growth comes from the market, stability comes from bonds. So instead of being way up here, 90, 75% in stocks, we're going to start bringing that down. And I'll work with them. Think about a landing, an approach for an airplane. They're on approach. The passengers feel it. You feel it in your gut. You feel it in your ears. Oh, we're descending. Oh, so perhaps it's in that last year, maybe 2 years out. You just start dialing down how much by percentage you hold in stocks. That gives you the volatility, but it also gives you the growth, and how much stability in bonds. And so it could be, and you're going to want to seek the professional, because we don't have an advisory agreement with anyone here, so I can't make a personal recommendation, but it could be 50-50, 50% in stocks, 50% in bonds, maybe 40% in equity, 60% in bonds for those who feel a little bit more squeamish. But the reality is you still need a degree of growth in your retirement years, because it's not only about, okay, I need to start taking money
Inflation.
out.
Yeah.
Inflation is eating it up. We've seen that for the last 2 years.
Sure.
It takes more of your dollars to buy the same bag of groceries that it did last year. So you still need that element of growth.
Great. Let's talk about a couple of one-offs. We have danced around the crypto.
Sure.
What's your view on crypto investing, being involved in that?
When you feel tempted to put money into something, be it crypto, gold, silver, you're now breaking the rules of prudent investing, and you're becoming a speculator. If you're a speculator and you're a gambler, go for it. You've greatly increased your risk to lose as well, but you've broken the rule of diversification. You're no longer diversified. You're in one thing, and you're hoping and praying, come on, baby. Now, in the early years on my podcast, Faith and Finances, I did 2 episodes on the blue collar millionaire. I did 2 warnings of crypto. Many of those have come to pass, where you have seen just billions wiped out because there's no underlying value, no security. And who was it? Michael Lewis just wrote a book on the most recent guy who got thrown in prison with the crazy hair. I can't think of his name right now, because he ran it as a Ponzi scheme and embellished his own lifestyle, and no one could measure how are we doing and who's holding my money in this crypto. And there's not a lot of securities. A lot of countries have just said, nope, we're not allowing it. Now, as that's starting to evolve and there's starting to be some regulations, it comes down to it. If you don't understand it, don't invest in it. Now, we look at it from the utility. Are we going to be using it? Sure. I mean, it's everywhere. Be a user of it, but don't speculate.
So, there was a day where precious metals were kind of seen as hedging. And so if I'm hearing you right, you don't even see it as hedging. And I guess another question I want to butt right up against that is, help the layman understand. We live it, I recognize that in our computer chips that we use precious metals. Obviously, there are applications to that, but are precious metals practically used the way they once were? Uh, are they a hedge or are they not a hedge?
Well, I like to use the evidence rather than opinions. You look at the evidence. They have a very poor track record, a very high standard deviation, and they actually trail their, as far as rates of return, inflation. However, it sells very well when you say, hey, semiconductors need silver and there's only so much. Look, I've got a 1-ounce bar of silver gifted to me on my high school graduation, 1985. It is worth less today than it was then. There's no growth. There's no compound growth. There's no earnings.
Yeah.
There's no employees. There's no There's no earnings report. How's it doing? Well, it's based on how people are emotionally feeling. What you see, Jim, all the time is every time there's a disruption in the market, the gold, we call them the gold bugs, will come out and say, "We told you." They'll use C-list actors. I have the security of, and they're not security sales companies, so they can use the words like safe. I
Right.
like the feeling of gold. Here's the
Yeah.
truth. I've got the paperwork right here. I acted like a potential buyer and I called the company. Okay.
Yep.
And in their paperwork, they say, now we've got a margin that they get paid.
Sure.
I'm quoting their paperwork. What happens is the average person who's thinking, oh, maybe gold, they'll look up gold and hey, let's call it $2,400 an ounce. So if I buy this quarter ounce coin, that should be 600. No. Back when I got this, gold was 2,000 a share, and I had someone referred to me to see if I can help them. He had already moved his IRA over. He moved 30,000. He got a statement saying the next month that his value was 15,000. And in tears, he says, "What happened?" And I went through the paperwork. They did sell him quarter ounce coins, but not for spot value. These are special coins. They've not been touched by human hands. They're golden American Eagle. Because they're specialty, we're going to sell them to you for $900 a coin. So he's immediately down, 50% or so.
Yeah, that's a racket. Yeah.
So how much how much is feeling good that you can hold something? Let's be practical. You're holding it. What are you going to do with it? You've already lost 40% right off the top because it's a special coin. How are you going to do commerce in a bad economy with this physical gold?
Mhm.
So it's feeding an emotional bias that says, I want to see it, I want to feel it. I had this conversation with a new client recently. We sat down and I said, why do you think that you want that? Well, because it's physical. I said, well, let's carry that thought out. Let's be realistic. What does that mean to you? Well, I can go drive by it and I see it. I said, we're sitting at a Starbucks. It's physical. There's some people right over there pouring drink. They're making money. You know what? There's thousands of these and they're physical. And if you owned a little bit of Starbucks, guess what? You're seeing it, you're feeling it, you're supporting it by drinking their coffee. Let's go over there to Chipotle. What car are you driving? It's physical. And what happens is people lose sight. They think that the stock is just something they see on the computer, that's at some trading floor. You own part of physical companies with physical assets that are doing business. And so to that, we've got a small slice in our portfolios that owns real estate. So rather than you taking a loan, having the liability that you're going to buy an investment property, now you're paying interest. Yeah, the renter is supposed to be paying that for you and property taxes. You look at all those costs and the liability, it costs you to have that investment versus having all of your money work for you through securities with no liability. It just kind of makes sense. So if we've got, let's say, 4% of our portfolio in real estate, those are thousands of holdings. So diversification, again, is the only free lunch in investing. Yeah, this property may fail, but thousands of others will, eventually, if not now or over time, do well. So diversify so that when it comes to anything that's hot, anything, you have to be aware of your own mental biases. And I won't name them. There's over 186 of them. Fear of missing out, comparison. You only live once. We saw that a couple of years ago with the GameStop playing in the Reddit forums that, they banded together. Let's run this thing up. Let's short it and all that. Those are games. Stay away from it. You'll also stay away from unnecessary losses.
So, for those of you who want to hear more, you've listened to this podcast, be sure to check out part 1 of our conversation. Tim, you've shared some really great wisdom. Let me sign off this way. You live in Tennessee in the greater Nashville area. So somebody might say, well, what good does that do me? I live in such and such, place in such and such a state. How might people reach out to you for, and what would they reach out to you for?
It's kind of cool that a couple of good things came from the pandemic shut down, a lot of people were leaving California. I was in California. I still have plenty of clients in California. I now have clients in almost all of the states except Louisiana. Uh, so we're able to, I've got a platform where proactively I'm educating you just like we are now. And then they get regular educational emails and personal coaching through technology that we're using right now and through email. And the beautiful thing is that I don't hold my clients' money. That's by design. We use third-party insured custodians. You've heard of them, like Charles Schwab.
Sure.
They're going to hold your money. I'm going to advise and guide and structure according to what you need as a financial fiduciary. So the website is FIN, short for financial, compass, COMPASS.org. And so there's a brief, I don't do a lot of marketing. I'm actually only taking clients that are referred by my existing clients because I get to, that's kind of nice. Or if they mention your show, happy to have a conversation. I haven't done any marketing since 2008, no sales, because I'm licensed as a fiduciary. That means I need to listen to what your needs are and point you in the right direction as to what's good for you. There's no products. Don't push products. I would be very wary of anyone pushing a particular product, and there's a lot of them out there. And there's also my email, which is tim@fincompass.org.
Tim, thank you so much. I sure appreciate the time that you have invested in what we're trying to do here as
It's been enjoyable.
shaping leaders.
I appreciate the privilege of being on.
God bless you, Tim.